Flight of capital, why FPIs left India in 2025 and how they may return. Foreign investors pulled out nearly $19 billion from Indian stocks in 2025, the worst year ever. The rupee fell past 91. FPI ownership hit a 15-year low. So, is foreign capital abandoning India? Not exactly. Let's explain what is really happening. So, you are watching Trick the Tricky. Let's start. This video explains the flight of capital from India in 2025, why foreign portfolio investors sold heavily, who replaced them, and what needs to change for foreign money to return. What actually happened in 2025? Record FPI outflows. FPI sold 1.5 to 1.6 lakh crore rupees of Indian equities. Worst FPI equity outflow year on record. FPI ownership in NSE-listed companies fell to a 15-year low, approx 17%. This shocked market, but context matters. The real reason: global push-pull, not India collapse. It was global. This was not a panic about India's economy. The global pull. US interest rate at highest level in 20 plus years. US bond yields looked very attractive. Investors moved money back to save dollar assets. When US yield rise means emerging markets suffer. Dollar strength and rupee weakness, which means feedback loop. Currency pressure. Rupee slipped past 91 rupee per dollar in 2025. When FPI sell, rupee weakens, currency losses scar more FPIs. More sellings follows. This currency flow loop was a major driver of exits. Valuations were too rich. Profit booking. By early 2025, India was trading at a premium to most global markets. Earning growth started moderating. FPIs booked profit and rebalanced portfolios. Money moved to US tech, AI markets, cheaper Asian markets like Korea, Taiwan, other emerging markets with lower valuations. Add global uncertainty to a mix. Risk of mood. US trade tariffs up to 50% on some Indian goods. Geopolitical tension, trade negotiations, uncertainty. In such times, FPIs reduce risk first, India included. Why Indian markets didn't crash? Domestic investors stepped in. This is the most important part. Who absorbed the selling? Domestic institutional investors, mutual funds, insurers, pension funds, retail investors. In 2025, DIIs bought 6 to 7 lakh crore rupees worth of equities. Retail ownership rose to 19%. DII's market share hit record highs. This domestic cushion prevented a major market collapse. Is the trend changing now? Early signs of stabilization. By late 2025, equity outflows moderated. Some weeks saw net FPI buying. US bond yields softened after Fed rate cuts. More importantly, debt flows turned positive. Big deal. Bond index inclusion. India's inclusion in global bond indices started bringing stable, rule-based foreign inflows. Estimated 20 to 25 billion dollar over time. These are long-term debt flows, not speculative equity money. They helped stabilize external balance, support the rupee, offset equity outflows. Will FPIs come back? Yes, but gradually, not a switch of process. Historically, equity flows return when global rates ease, currency stabilizes, valuations become attractive, earning growth improves. These conditions are forming but not fully aligned yet. A full reversal is more likely in 2026, not overnight. What policymakers need to do? How to attract FPIs again? The infographic highlights four key steps. RBI must stabilize the rupee. Bond yield should fall for the right reasons. Equity valuations must normalize versus peers. Earning growth must justify prices. Meanwhile, SEBI must ensure rising retail participation stays healthy and disciplined. Big picture takeaway: India didn't break, capital rotated. 2025 was not about India becoming unattractive, it was about global capital reallocation, high US rates, currency pressures. India showed resilience because domestic investors stepped up and debt inflows turned positive. So, in one line, FPIs left India in 2025 due to global rates, currency pressure, and valuations, not weak fundamentals, and their return is likely to be gradual, not sudden. Conclusion: India's markets proved they can survive without hot foreign money. When FPIs return, and they will be joining a much stronger domestic base. So if this explainer helped you, hit like, comment below. Do you think India needs FPIs anymore or are DIIs enough? And subscribe for more simple explainers on markets and the economy. Thank you.